In this video, we're going to cover the All-Star cash flow. So up until now, we've covered some theory on the cash flow, and now we want to put this into practice. Just before we put the cash flow into practice, let's do a quick recap so we can get some context around what we've covered and where we are. We have spent some time on the income statement, and we've learned that the retained earnings feeds into the balance sheet, and it's cumulative in the balance sheet under retained earnings. We've spoken about sources of capital, the equity and the debt in the business, and how this money is used to finance the operations of the business. And here we've spoken about the fixed assets, and current liabilities. In All-Star, when we did the example, we solved for cash. In other words, we forced the balance sheet to balance. And practically what we should be doing is we should be going to do a cash flow statement to calculate the cash position in the business, and then take this number and put it into the balance sheet, and then it balances. So we're coming at this from the other side now. Having forced our balance sheet to balance, we at least want to check if our balancing number is correct, and the cash in minus cash out of a cash flow exercise helps us find this net cash position that typically makes up the cash and overdraft position in the business. So let's get into that. I'm going to bring into screen my cash flow statement for All-Star, and we're going to go through this together in order to understand how cash flow works. So let's start off with this list of sources and flows here on the left hand side. I have identified the 5 sources of cash flow for All-Star, and I've listed them here. So if you recall, we covered these sources of cash, one being the operations, the other being, or the second one being, the working capital. The third one was investments or fixed assets. The fourth one was financing, and the fifth one was dividends. And then there's this tax one all on its own here. And I've just identified, in the context of All-Star, the operating profit was an inflow, and I know that just because it's a positive number. I looked at the stock and the debtors from one year to the next, and I saw that they were higher in the second year. So that says to me this is an outflow, and we'll cover that in a little bit more detail shortly. The creditors, there was no change from one year to the next, so no cash flow impact. For fixed assets, All-Star purchased new assets, and that therefore represented an outflow of cash. It raised some debt funding, and that represented an inflow. And then all of these items were income statement items. The interest is part of financing, the dividends was an outflow, and the tax was all an outflow. So once I had identified the direction of flow, of cash flow for these items, I simply took these headings and I put them into 2 separate lists. I said, what are the cash ins? And there's only 2, operating profit and long-term debt. And what are the cash outs? And I simply listed them under these 2 different headings. Now what we're going to do is we're going to go and find the numbers that relate to these headings, and we're going to do a cash in, cash out calculation. So let's start with the operating profit. We want to go to the income statement, and we want to get the operating profit from the 2018 year. There it is. So we're taking into account the sales, the cost of sales, all these expenses, and we're putting that into the cash flow statement at 875,000. Now remember, that operating profit has had the depreciation deducted, even though depreciation is not an expense that gets paid to someone. We refer to it as a non-cash expense. So if it actually hasn't been paid out of the business, we need to add it back here. so that we get what we might call the cash from operations. So let's go and find that depreciation number. There it is, 525,000. Let's put it in there. Let's add these together. And now we have this 1.4 million, which is, let's call that the inflow or the cash in from the operations. So that was source of cash number 1 complete. Let's move on to the working capital components, and to do that we are going to do the stock. Let's do the stock first. So we need to go to the balance sheet, and we need to ask ourselves, looking at the stock items, from one year to the next, has the stock gone up or down? And our working capital rules tell us if the stock has gone up, which is the case here, our cash has gone down. How much has the cash gone down by? Well, it's the difference between the two. So you'll find some numbers that I've put in here on the right hand side that have done this calculation for me, and there you see it's simply the one minus the other, and I've got a negative sign there because I said 212 minus 79, and that gave us an outflow of 133,000. Now in my cash flow, cash in and out here, I don't want to show positive and negative signs, not for now, because this heading says everything in here is going to be a cash out. So I want to put a number in there that is that number, 133,000, to represent the stock has gone up, therefore the cash has gone out. I'm going to do the same thing for the debtors. So in the balance sheet, notice how the debtors has gone up, therefore the cash has gone down by the difference between the two. So I'm going to use that number in here to represent the outflow. The creditors, I said here earlier that there was no change. Let's just confirm that. Notice how those two numbers are the same. So there's no impact on the cash flow. Now, ideally, what I would like to happen is, because our cost of sales has gone up, remember this cost of sales, money we owe, money we pay to our suppliers, because that's gone up, I would have preferred that my creditors have gone up. If I'm buying more from my suppliers, I might owe them more. Now, under those conditions, if our creditors went up, this would be a positive inflow, a source of cash for us. So something's going on here, that our cost of sales is going up, but our creditors aren't. And we're going to come back and visit that under some analysis a little bit later on. But for now, our creditors are 0, so I've actually left it out of the cash flow items. The next one is the fixed assets, the purchase of new assets. So what's important that we recognize here, this is only the purchase of the manufacturing equipment that was made during this year. We didn't buy the fleet of vehicles this year. That was done in previous years. So we need to get the number in there. So to do that, we're going to go to the balance sheet, and we're going to find a calculation here on the right hand side. In fact, I'm just going to delete that calculation and I'm going to redo it. And the way I'm going to do it is as follows. I'm going to say at the end of 2018, we have this amount of assets. But that's at the end of the year. I need to know what's the value of those assets, the manufacturing equipment and the fleet of vehicles at the beginning of the year. So to get the value at the beginning of the year, I have to add back to this 525,000 Rand. All right, that gets us to the value at the beginning of the year. And now what's contained in this number is the fleet of vehicles and the new manufacturing plant. But we didn't buy the fleet of vehicles this year, so what we want to do is we want to subtract from that the fleet of vehicles on the balance sheet to be left with the 1.2 million that was invested in the manufacturing plant. All right, so that's the number we can use here in cash out. Let's make this equal to that number. and that was a cash outflow of 1.2 million. So we've dealt with the fixed assets. The next source of cash was the new debt, and this one was actually quite straightforward because the story told us that he borrowed R1 million, and there you see he had no debt, and now they have R1 million worth of debt, and really what we want to do is get the difference between the two, and that's obviously R1 million. So for our cash in, we're going to say this is equal to the cash flow that came in there, and that takes care of cash in. Now the interest was cash out. Well, that's quite straightforward. We're going to go to the income statement and find the interest expense there of 162,000. We'll put that in there. The next one on our list here was dividends. That's cash flow to shareholders. So let's go to the income statement and find that dividend flow. There it is. And last of all, let's put the tax amount that was paid in there. And that taxation is 249,550. Okay, so now let's move these over a little bit just to give us some working space here. We have got a list of cash ins, list of cash outs, and a list of cash ins over here. Let's do a little calculation here at the bottom. We want to add these two together to get the cash inflow. And over here, we're going to do just a little sum, and we'll add these together to get a cash outflow. And then what we might do is we might say, what is the cash in minus the cash out? And what we've determined here for the year is that there's a net outflow of 50,000 Rand. 50,000 and some change. So the ins and the outs through the year have resulted in an outflow of 50,000. Now, the next step is to say, well, how much cash did we have at the beginning of the year? And to find that number, go to the balance sheet for 2017 and find the net cash position here. And what's the net cash position? Cash minus overdraft gives you net cash. The net cash position is 43,408. And what if we say 43,408 plus the outflow? We'll be left with the net cash position. Let's adjust that formatting there. Do that the other way around. Take some zeros out. What we've done is we've said we started with 43,408, 50,000 and some change went out. So what are we left with? We're left with this number of 7070 negative. All right, so that then should equate to the net cash position in our balance sheet. Let's go and have a look. So we have 35,000 and some change in cash, and we have some overdraft. What's the net position for these two? If you say the one minus the other, there you have 7070, and it's negative. So we have balanced perfectly. We have shown that the calculations that we did to force the balance sheet to balance worked for us, and that's because all the other numbers in the cash flow statement were correct. All right, so we've done a cash flow statement, if you want, for the All-Star business in a very simplistic cash in, cash out way. And for me, this is the easiest way to understand cash flow. Of course, it's not the way that accountants do it, because easy and understandable is not necessarily the process that accountants follow. What accountants do is they take these two lists of cash in and cash out, if you want, and they shuffle them together into these 5 different sources of cash flow. And what emerges is something that looks like this. So here we are in 2018, and notice what the first items are here. They are operating profit, add back depreciation, cash flow from trading. So we did that. The next items here are changes in working capital. And there you see those numbers that we calculated in the balance sheet from one year to the next. And what's important here is that there's a negative sign in front of it, of these numbers. That represents the outflow. So previously, where we had it in two different lists, in and out, when you put it together in one long list, you must show the sign, positive or negative, on which way the cash is flowing. All right. Creditors was 0. There was our purchase of fixed assets. Here's our financing activities, long-term loan, interest payments. Down here was the dividend, and then there was the tax paid. And then right at the end, we came down to this number of 7070. So you'll recognize all the same numbers here. One other difference is that you'll see some, let's call them subtotals on the way down. Accountants love their subtotals. All right, I don't think there's much value in the subtotals. I really want to see just the transactions that have caused the change in cash flow, but that's just a personal preference. All right, so I hope that gives you some indication of how the cash flow for All-Star works and how to find those cash items in the income statement and balance sheet and construct a cash flow statement for a business. Again, the best thing is to go and practice some other examples in order to get better at this.